If you think a share price is going to go up, you can buy a call option. If you think the share price is going to go down, you can buy a put option. But what if you do not know the direction of the particular share price and you think that they will make a huge movement? Example, I have Tesla on my charts and I know that Tesla is an extremely volatile stock because it has a very charismatic chairman who makes certain comment and the share price will go either up or down. Now, the earnings is coming in July and I do not know which direction the price will go. So what I do is I buy a call and a put at the same time. This is known as a straddle. You can see that in this particular chart, I established a 26th of July straddle by buying a call and a put at the same time. Looking at the risk graph, you can see if the share price goes up, I will make profit. If the share price goes down, I will make profit. However, if the share doesn't move, that's where I'll make a losses due to time decay. Do take note that when we establish this particular strategy, it's important to purchase it when the IV percentile is extremely low. And let me share with you why. If you look at before the expiry date, if the implied volatility is high, there's a chance for it to drop. And when it drops, you can see that we will go into the negative zone. Now, conversely, if we buy it at a low IV percentile, and when the IV percentile spikes because it's near earnings, you can see with an increase in IV percentile, I go into the profit zone, even though the share price did not move as much as I want. So in the case of Tesla, even before earnings, they make an announcement and the share price went all the way up above into my profit zone. So this is how you establish a straddle. To learn more about options, follow this channel and also click on the link to receive more free resources so that you can become a better investor and trader.